Hey guys, welcome back. Today we're going to be looking at the stock market to GDP ratio. This is a famous ratio that Warren Buffett likes to use to give an indication of, what the total market cap is to what the current GDP ratio is, and probably gives us the best single measure of where the whole market as a whole, where valuations stand at any one sort of point in time. So we're going to sort of do a little bit of a dive into see, how the US market's stacking up, and then we're going to compare it to the Australian market to try and get a gauge on where the markets are currently sitting as a whole, not just individual companies, but as a whole. Is the market currently overvalued? Is it undervalued? And how we can use this in our own investing. We'll start off by looking at the American market, then we'll look at the Australian market, and then we'll sort of try and compare the two to see how we're currently sitting. And in the end, I'll sort of give my take: am I buying, am I selling, or what am I doing? And I'd love to get a bit of a conversation going on this. Where do you guys sort of see the market? Obviously, last week we've seen the market pull back a little bit. But yeah, I'd love to get a bit more of a conversation in the comments below. So hear your guys' input. Where do you currently see the market? Are we currently overvalued? All right, guys. So we're going to start with the US market. We're going to take the entire US stock market as a whole, every single company on the US stock market, and then we're going to divide it by the GDP ratio. Okay, the gross domestic product. So this will tell us what the current ratio is, and it'll sort of give us an indication: is the market currently overvalued? Okay, gross domestic product is basically all the goods and services that country has produced over a set period of time. It's a good indication of how the country's sort of going and how the health and the general overall performance of the country is sort of sitting. So let's crack into this first graph here. And all right, guys, so I'm using current market valuation Dotcom Buffett Indicator, and the current US market value is coming in at $42.1 trillion to the current estimated GDP at $20.9 trillion, giving us the Buffett Indicator of 203%. So from their calculations, they're saying that the US market here we're talking, is currently 66% higher than the historical average, suggesting that the market is strongly overvalued, and they haven't seen these sort of levels since the internet bubble in the early 2000s. So looking at the chart below, we can see, in the internet bubble just before the market severely dropped off, they were sitting at 71%, and then it dropped back off, and then you can see then later on in 2008, it was just comparable to now. It wasn't that bad at all, but it was slightly overvalued, and then it dropped back to being quite undervalued at the bottom there in sort of 2009, sort of early 2010, to the lows of 46% for the Buffett Indicator, negative 46%, and has just been on a steady climb basically all the way up until earlier this year in March, when it took a bit of a dive back. But now currently we're sitting at 66% over historical averages on October 22nd. Now have a look at the trend line to see where the US market should sort of be sitting, and then we'll tie that back to the initial graph there where we looked at where it's currently sitting, just to see how the historical trend line is. Generally over time the markets do go up. Use the analogy as someone walking up a hill, let's say, and they're playing with a yo-yo. And as they're going up the hill, obviously the market's going up and down as the yo-yo is going up and down. But generally they're still walking up a hill, and the yo-yo is the up and down of the market, let's say. Real basic analogy, just gives you a picture of the market as a whole moving forward. This is the US market, but generally all markets as a whole, they're generally going up. So let's have a quick look at the historical trend line to see where we're currently sitting. So as we look at the historical trend line here, guys, we can see, roughly where we should be sitting, and that, to be fairly valued, that is, compared to GDP, and we're currently 66% above where the historical trend line is sort of showing us where we should be. Anyway, let's move on to the Australian market to get a bit more of a gauge on how we're sort of sitting locally, and how we can use this in our own investing here in Australia and New Zealand. We're going to have a look at the Australian market to see how we're stacking up compared to the Americans, okay? See how our market's sort of faring through this whole last 6 months. It's been a real unpredictable time. Markets have been up and down, sideways, all over the place. So let's have a bit of a look to see how the Australian market's shaping up. I'm going to be using gurufocus.com. Great website if you want to do some research into companies or into the 13F filings of US-based investors. If you don't know what a 13F filing is, guys, check out my other video I did on Copy the Best, where you can basically copy any of these big value time investors in America and look up their 13F filing to see what they've been buying in the last quarter. Anyway, so let's jump in and have a quick look at the Australian GDP ratio. Okay, so we're looking over on the GDP ratio here of the Australian total market cap to GDP, and we were hitting some all-time lofty highs back just before the GFC kicked off, coming in at 220%, which is real high. I wasn't looking at it at the time. I was currently traveling at this point in time, and I was sort of not really following the markets too closely at the time. But then, as you can see there, it's really dropped straight off, and dropped right back down to just a touch over 90% there. And that would have been in early 2009. And then it's sort of just been plodding along, took back up a bit there. And then fast forward to where we are today. This is only going over the last 20 years, guys, so bear that in mind. To sitting where we are today at 101, just a touch over 100% there. So we're not sitting too bad, really. We're sitting pretty much where we should be, really. Compared to the US market, we're sitting not too bad. Things aren't crazy overvalued, not super cheap at the moment either. But let's say, we have a correction in America, then our market will affect this as well. So then, companies in Australia could become a lot more cheaper, and there could be some good value there in a lot of companies here in Australia. Okay, so we're just going to look at the different ratios here. So anything under 93% they're saying is significantly undervalued. 93 to 119, modestly undervalued. 119 to 146%, fair valued. And 146 to 172%, modestly overvalued. And anything over 172%, significantly overvalued. So today we were looking at, this is on the 31st of October 2020. They are currently saying that the Australian stock market is modestly undervalued. Okay, this is the market as a whole, guys. So this is not taking into account individual companies or anything, but as a whole, according to this ratio, which, like I said earlier, this is Warren Buffett's the famous, the Buffett indicator that he likes to use just to give a real basic sort of quick measure on whole as the whole market is looking. This is where they're currently saying the Australian market. So that's sort of saying that the Australian market's not too bad. It's sort of sitting where it should be, whereas compared to the American market, where that is significantly overvalued, where here's in Australia, they're even saying we're significantly, they're slightly undervalued sort of thing. But I'd love to get your guys' thoughts on this. Where do you sort of see the Australian market compared to the US market? Drop it in the comments below where you sort of see it sitting. Okay, guys, so we're going to have a quick look at the PE ratio of the Australian stock market as well, just to give us another indication of how the Australian stock market's looking with regards to overvalued or undervalued, just to give us a real sort of rough gauge as well. It's another thing I like to look at, especially in particular companies I'm investing in, but also as the market as a whole, just to see how the whole market's sitting. So let's jump in and have a quick look at this graph below. So as we can see, historically, the Australian stock market over the last sort of 40 years or so, historically the PE ratio has sort of been around that 15 sort of mark. So even in, the last crash was sort of, in the GFC, let's say, you can say going into, 2007 was sort of 13, 14, and then it dropped right back down to just over 8 at the lowest in early 2009, and then it's just come back up to around that 15 and sort of been hovering around that the last sort of 10 years until you fast forward out to today. Even earlier in the year, sort of going into, Feb, March, was around 18, 19, and then dropped back down to 15.36 in March when the market took a bit of a turn. And then if you fast forward that out to today, coming in at August 2020, they're coming in at 39.84. Okay, so that's how much the market is prepared to pay as a whole. All investors, this is retail and institutional investors as well, all the different hedge funds out there, the Beta Shares, the Vanguard, the BlackRock, that's how much they're prepared to pay for $1 of earnings. Okay, so they're pretty optimistic on where they see the market in the future. I mean, you can use this as a little bit of indication on, is the market currently overvalued or not? Just another thing to think about when you're currently investing. So looking over both graphs there, in my opinion, I think that the American market is quite overvalued, especially in the tech sector. I mean, I don't totally understand the tech sector. It's not in my area of competence. So, but I generally look at the whole tech sector in America as being quite overvalued, and just the general market as a whole. If you look at that and compare that to, the GDP and just what the state of the world at the moment, there's a total separation there between the two of where we're currently sitting. Whereas locally back here in Australia and New Zealand, it's not quite as bad. You could say even New Zealand and Australia that maybe we're slightly above where we should be as well. But that's just my take on it. I'd love to know your guys' thoughts. Drop it in the comments below what you guys think. Do you think we're currently undervalued, overvalued? And then as a whole, I'm not talking about individual companies today. I'm just talking about the entire stock market as a whole, the entire New Zealand market, the entire Australian market, and the entire US market as a whole. Where do you guys sort of see it sitting, I'm currently not buying or selling. I'm sort of just sitting on the fence at the moment. I do have a small portfolio. And, even through the last correction, I didn't sell or anything. So you've always got to think about this when you're investing. Make sure you have a solid strategy when you're investing. So, if there is a correction in the market, you don't just panic sell at the bottom and then you miss out on all the huge growth that's happened over the last 6 months. Has been a perfect example of that. So always have that in mind when you're investing, that you have a solid plan before you invest any money into anything. You have a solid plan of how long you want to invest for, when you want to get out, so that you don't, act irrationally when the market tanks and you see the value of your investment dropping back. So it's something to bear in mind. It's very hard sometimes to not do that when you see your market, your portfolio dropped by 50% or something, and it's real hard not to sell that. But as long as you have a solid plan going into it to ride out these storms, then you'll be fine. You'll come out better in the long term. Okay, so this is just sort of my take on it, and this is something you can bring into your own investing. Just have a quick look at stock market to GDP ratio on that particular market that you're investing in. Gives you a good indication, especially if you're thinking about investing into ETFs, okay, which a lot of new investors do, and I recommend it. It's a great way to give you good diversification. But let's say that you're thinking about investing into an ETF and you're buying into the US market currently, which is potentially quite overvalued. You could see you're essentially buying the entire ETF, you're buying the entire market, let's say. That could drop right back as well with the entire market. So bear that in mind, even with your ETF investing as well, okay? So something to look at, something to think about when you're you're investing. But like I said, guys, I'm not a financial advisor. I'm not an economist. This is just my sort of view on it. But yeah, hope you got some value from today, guys. You know the drill. If you enjoyed the video, guys, hit that like button. It's much appreciated. It helps push this video out a bit further. And if you want to see some more investing videos in the future, then hit that subscribe button and you'll be the first to know when the next video drops. All right, guys, enjoy the rest of your weekend. We'll catch you next week. See ya.